41 million Vietnamese Dong. That's the crushing difference in passive income some savers are losing out on right now. This isn't theoretical. This is real money, vanished from their pockets in just 1 year, purely by choosing the wrong bank. Yesterday, August 24th, 2026, new online deposit rates dropped across 34 banks. And what's wild is the massive divide. We're talking about a stark contrast in how much banks are willing to pay you to hold your cash. On one end, you've got ACB leading the pack with a solid 7.8% annual interest for a 12-month deposit, while other players like LP Bank and Saigon Bank hover around 7.2%. But then the big four, your Agribank, BIDV, Vietcombank, Vietinbank, they're holding steady at a lower 6.8%. This isn't just numbers. This is about strategic placement of your capital for true passive income. Here's the cold hard data from the market yesterday. The spread between the best and worst 12-month online deposit rates hit a shocking 4.1 percentage points. Think about that for a second. While ACB is offering a robust 7.8% for your 12-month deposit, SCB is sitting all the way down at 3.7%. If you dropped 1 billion Vietnamese Dong into the wrong account, you'd be looking at a mere 37 million Dong in interest, compared to a fat 78 million Dong if you picked wisely. That's 41 million Dong in potential earnings that simply evaporated, not because of a bad investment, but a passive choice. This isn't just small change, it's a significant chunk of your potential wealth. Gone. What nobody's mentioning is that this isn't just about saving, it's about strategic capital allocation for your side hustle or business. Many entrepreneurs, focused on their Shopify store or Amazon FBA inventory, overlook optimizing their idle cash. That 4.1% difference isn't just a number, it's free capital you could be reinvesting, using for marketing, or simply compounding. Imagine if that 41 million Dong difference funded a new product launch or a powerful YouTube ad campaign. This gap highlights the critical need to treat every asset, even your bank deposits, as a revenue stream. Don't be passive about your passive income. Before you chase the next big trend, audit your existing capital. Today's action step: review your current bank's interest rates against the top performers mentioned. If your bank isn't paying you competitively, move your money. It's a simple, high-impact move for your bottom line. Hit subscribe so you don't miss more real money strategies. Market observers are already sounding alarms, pointing to the widening chasm in deposit rates as a sign of underlying systemic pressure. They're not just seeing numbers, they're seeing a clear stress test for smaller banks struggling to attract capital against the Big Four's established stability, even at lower rates. This differentiation, particularly the 7.8% offered by ACB compared to the Big Four's 6.8% on 12-month terms, creates an undeniable urgency for businesses to reevaluate their cash management. Entrepreneurs with significant operating capital simply cannot afford to ignore this 1% spread. It's not passive income when you're actively losing out. The smart money moves fast, always chasing that higher return. Capital always seeks the best yield, a fundamental truth for any globally minded entrepreneur. While these rate shifts are localized, the mindset required to navigate them is universal. Business owners around the world constantly sharpen their focus for every basis point. You can't run a competitive Shopify store or scale an Amazon FBA operation if your fundamental capital is earning 1% less than a competitor's. That 7.8% from ACB isn't just a local number. It's a benchmark for capital efficiency that, if missed, can put your business at a significant disadvantage against others thinking globally. It forces a brutal truth. Complacency with your cash costs you global competitiveness. History's littered with examples of businesses that thrived or crumbled based on their ability to adapt to interest rate volatility. Think back to periods where deposit rates diverged sharply. The pattern is always the same. Those who diversified their cash holdings or actively sought out the highest rates like ACB's 7.8% often weathered economic shifts far better. Meanwhile, businesses too comfortable with their legacy banks sitting on 6.8% watched their working capital erode in real terms. It's a classic tale of financial Darwinism playing out in real time. This isn't just about small differences. It's about exposing vulnerabilities in your business model if you don't stay agile. Who's truly winning and losing from this interest rate shakeup? Beyond the obvious banks like ACB pulling in deposits with their 7.8% offer, the unexpected winners are the agile, digital-first businesses. SaaS startups and freelance consultants, often operating with minimal physical overhead, can park their operating cash in these higher-yield accounts, effectively subsidizing their burn rate. The real losers? Small businesses tied to traditional banking relationships, too busy running day-to-day operations to notice their capital languishing at 6.8%. Also, those still holding significant cash in low-yield traditional accounts, believing loyalty pays off. It's a silent wealth transfer happening right under their noses.